Hey guys, it's Jansen here and welcome back to the channel. In this week's video, we are going to be talking about the advantages of regularly investing your savings as opposed to getting all of your savings and then just making one lump sum investment, or alternatively, getting your savings and then just randomly investing them in the markets based on whatever's happening in the news that week. Now, in order to demonstrate each of those investment strategies, I'm going to be pretending that I did follow each of those throughout the entirety of 2020. So hopefully in the example that we're going to be running through, I'm going to actually clearly show you why regular investing is a better option. But before we get into that, let's just discuss theoretically why regular investing is going to fare better for you in the long run than doing a lump sum investment or just doing random investments based on whatever's happening in the news. Okay, so let's say that hypothetically you've got £1,000 to invest and you do your research on the different funds, the different companies available, and you think, do you know what, I'm going to put all of that £1,000 investment into a single fund. Now, the clear advantage of doing that is that you could get very lucky. You could invest at the perfect time, and over the next few weeks, the next few months, the value of your investment skyrockets. Happy days. But what you also need to consider is the alternative. What happens if you've actually picked a very bad time to invest, and over the next coming weeks, the next few months, the value of your investment reduces substantially? Two things are going to happen there. The first is that you are going to get very demotivated about investing in the future. You'll probably feel quite upset and you might think, do you know what? I think the market might fall even more. I'm going to sell and make a loss. So that's the first thing that could happen. The second thing that could happen is you might think, what the heck? There's no way that this company or this fund should be valued this low. I want to invest more so that I can benefit when it inevitably goes up. Well, if you've invested all of your money on day one, you're not going to have any more savings to be able to invest and to essentially benefit from the fact that the market is undervaluing your investment. So those are kind of two main reasons not to do a lump sum investment. Of course, you may get lucky, you may pick the perfect time and immediately benefit from any increase in the share price or fund value. But you've got a very high chance that things could go badly, not in your favor, if you haven't done the proper research or if something happens like the coronavirus, which could ultimately wipe out a significant part of your investment. So those two reasons there are enough of a reason not to do the lump sum investment method, because, you could get lucky, I guess, but you have to think about the downside. What happens if you've picked a very bad time or something happens in the market and you end up seeing your investment lose a significant amount of value? Now, the second strategy that you could follow is basically where you just keep all of your investment and you think, I'll just invest it based on whatever's happening in the news that week. So let's just pretend that you had done that with £1,000 investment. Well, one thing that you need to consider is, again, yes, you could get lucky. You could think, actually, they found a cure for the coronavirus, so the markets are going to go up. So I'll put a bit in now and then I'll put a bit in next week. You could get lucky and the markets do continue rising. Or alternatively, you could find that you've done that. You've basically put all your money in based on a new story that could later be found out to be untrue or not as beneficial as everybody thinks. And then in that case, just like with the lump investment example, you've got no further money to invest, or you end up seeing the value of your investment reduce. So now if we flip to the regular investment option, think about how the negatives of the previous strategies won't really impact the regular investment strategy, because you are going to be splitting your savings up over the course of a year and regularly investing them. So if the market continues going up, your initial investment is going to benefit, although it won't be quite as much as in the other examples. But even better is if the market does go down for whatever reason, whether there's just less demand for certain securities or something happens in the markets, you're going to be able to benefit from something known as dollar cost averaging. So the average price of your investment, the more you make over a period of time, is going to average out. And if the markets temporarily go down, you're going to be able to invest at cheaper price points so that when the markets do hopefully improve, you'll be in a much better position financially. So now that we've kind of covered that, let's do an actual real example as though we'd followed those 3 strategies throughout 2020, and let's see what would have happened to our returns with each of those strategies. So this chart here shows the S&P 500's performance throughout 2020. Now the S&P 500 is quite simply the share prices of the 500 biggest public companies in the US combined and then averaged out very simplistically. So this is a very good indicator of how the 500 biggest companies in the US are performing. So if you wanted exposure to that, if you want exposure to Facebook, to Amazon, etc., you would invest, or you could invest in the S&P 500. So let's say for this example, we have got £10,000 to invest, and we've got 3 separate people following 3 different investment strategies. The first one we've got is going to be called Lump Sum Larry. And Larry is just going to invest £10,000 on day one, and he's going to forget about it. The second one that we've got is going to be somebody that just acts on emotion. So they'll invest a bit today, and then they're going to invest in the future based on whatever's happening in the news that week. So let's call them Emotional Eric. And then the third one is going to be somebody that invests regularly over the period of a year. So let's say at the end of each month, and that's going to be Regular Rick. Okay, so let's say that all 3 of those people, it's the beginning of the year and they have a New Year's resolution to start investing in the markets to see if they can actually grow their savings. So let's say that all of them make an investment at the end of January, just about here, where the value of the S&P 500 is 3,284. Okay, so let's now see what happens to Lump Sum Larry's investment if he put that entire 10K in at the end of January, and then today, kind of end of November, he's decided he wants to sell. Instead, he wants to buy a car or put down a deposit for a house. So Lump Sum Larry, when he invested in 3284, and the value today is 3556. So if you work out what that would have been with a £10,000 investment, bought at 3284 and sold at 3556, that would have been an 8% gain. You'll have to excuse my writing. So now that we've seen how Lump Sum Larry did with his single investment, he made 8% over the period of 2020, which is okay. It's pretty good considering the amount of risk that he took. Let's now look at Emotional Eric. So let's say Emotional Eric, he puts in £5,000 at the same point as Lump Sum Larry did, and then he keeps £5,000 to the side and he's like, I'm just going to see what happens with the markets. Now, just a few weeks after he made that initial investment, you can see the markets went down significantly, and that's because of the coronavirus and the lockdowns that were imposed globally. So he's thinking, oh no, my initial investment has gone down. Should I sell? I'm definitely not going to invest. But fortunately, he keeps his investment. Now, over the course of the next few months, he starts to see the markets improving, and he's thinking, no, it's just a short-term thing. I'm not going to invest anything more. He sees the markets continuing to improve, and then around here is where his confidence picks up slightly, because he sees the market drop slightly, then picks up again, and he's like, I think this is the point to invest. The media are being very positive. They're now saying there's going to be a cure. I think that now's the right time to invest. So let's say that he invests right here. So now that Emotional Eric has invested all £10,000 of his savings, let's have a look at what his theoretical gains would have been had he sold today. So first of all, just like Lump Sum Larry, he invested at the end of January, but this time he put in £5,000 at 3284. And then he did another investment in September when he thought, you know what, I think the markets are improving. They're only going to go up now. And he's done another £5,000, this time at 3341. So if you pretend that he sold his investment today on the first and second investment, so he sold the entirety, he would have made a profit of £700, which equates to a 7% gain. So he actually is in a worse position than Lump Sum Larry. And that's just basically because of the timing of the markets. So let's now flip to the final one, the regular Rick, where hopefully we're now going to see that the regular investor that just does it automatically by standing order or direct debit at the end of each month, let's just see what his returns would have been with that strategy. Okay, so regular Rick is going to be investing over the 10 months that have passed £1,000 per month. So not £5,000, not £10,000. He's just got his entire amount of savings and he's divided it by 10. So £1,000. So he's going to be investing here. He's going to be investing here. He's going to be investing here, here, etc. So let's just fill those out. So whilst the value of the S&P 500 did go down quite significantly here, you can see that regular Rick has been able to benefit from that because he's been able to put in £1,000 at this point here and £1,000 at this point here. So that as the year has progressed, those investments have gained. As the S&P has recovered, those investments have gained the most, and so have the ones subsequent to that as the S&P 500 has continued to recover. So let's now have a look at what regular Rick's returns have been by following that strategy. The returns would have been, had he done that and sold today, a whopping 16% gain, which is twice the value of the lump sum method and more than twice the value of the emotional method. And it's been done in a much lower, in a fashion that reduces risk substantially, because the markets did go down and regular Rick had money to continue investing to benefit from dollar cost averaging. Whereas the other two guys, one was emotional and was letting the media and all sorts play on his mind, and the other one just had no more money to invest. Those other two were not able to benefit from that. So I'm hoping that by showing it like this with a real life example, you can see the clear advantages of regular investing, not just from a dollar cost averaging point of view if the markets go down, but also from a headspace point of view. You're going to feel way less anxious and stressed if you do regular investing versus if you put all of your savings into the markets and you see that the stock market's gone down, and you're going to feel stressed and anxious and worried and be thinking, should I sell? What should I do? And so on. So I hope that's clear. The regular investment strategy is something that I follow myself. And as I mentioned, it's really easy to set up with most brokers or fund investment platforms or whatever. So I hope you've enjoyed this video, guys. I hope you like the tutorial style with the drawing and that you could actually read my writing. If you have enjoyed it, please remember to subscribe. And if you've got any comments or requests, don't forget to post them in the comment section below. I'll see you next time.